we had the big spectacular price run up in January of silver, and it hit $122 an ounce. And I've been saying for years, silver is destined for triple digits. It will be in the triple digits, and it's all just a matter of the underlying fundamentals. Now, Jeff Christian, in a panel that we were on, responded to that as triple-digit silver is Coke-induced nonsense. Well, I've already been proven right, but for a short period of time, before the end of this year, I believe that we are going to be back up in the triple digits in silver. This ratio will start falling again, and we are destined for something like this. So I believe the big opportunity, however, it's a lot more volatile, is in silver.
Silver's recent surge into triple-digit territory may have been brief, but it reinforces a much larger thesis that has been building for years. The move to $122 wasn't an anomaly. It was a signal of what underlying fundamentals are capable of producing when momentum aligns with tightening supply and rising demand. Mike Maloney, a well-known precious metals investor and educator, has long argued that silver's path toward triple digits is inevitable. Despite skepticism from mainstream analysts, recent price action has already validated that trajectory, even if temporarily. The key takeaway is not the short-term peak, but the confirmation of a broader trend that remains intact. As the gold-to-silver ratio begins to shift and market conditions evolve, silver's volatility may create both risk and opportunity. However, that same volatility is what fuels its upside potential, positioning it as one of the most explosive assets in the current cycle. Now, we present the clips from Mike Maloney's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
When I asked Jeff Christian about whether he thought the Hunt brothers were responsible for driving the price of silver up to $50, and it was actually $52.50 intraday in 1980, he said that he thought that they added 50 to 75 cents at the most to the price, that this was actually the public changing their preference. And that was my theory. In 1980, the average income was just below $10,000 annually. And so a guy goes to the bank and withdraws $500 or $1,000, and that may have been the majority of his savings at the time, and rushes into a coin shop and says, I want to buy gold too. And this is while the lines at coin shops in January 1980 in the United States and in Europe, they were being compared to the lines of Star Wars and Apocalypse Now. I mean, these lines went out the front door and wrapped around the block. It was a panic because the dollar actually came very, very close to failing. The Hunt brothers were used as a scapegoat to save the dollar by capping the price of gold. If a guy rushed into a coin shop and said, I want to buy gold too, and he had $500 or $1,000, they would drop 1 or 2 coins in his hand, and that's it. You'd go, oh, is that all I can get? How much is this silver? Well, the silver, you can get 40 of those for one of these. Oh, well, I'll take the silver. And so that is the reason for this spike down, which is silver going up faster than gold, measured in dollars. And this isn't over until it's over. Now, we had the big spectacular price run up in January of silver, and it hit $122 an ounce. And I've been saying for years, silver is destined for triple digits. It will be in the triple digits, and it's all just a matter of the underlying fundamentals. Now, Jeff Christian, in a panel that we were on, responded to that as triple-digit silver is Coke-induced nonsense. Well, I've already been proven right, but for a short period of time, before the end of this year, I believe that we are going to be back up in the triple digits in silver. This ratio will start falling again, and we are destined for something like this. So I believe the big opportunity, however, it's a lot more volatile, is in silver. Jesse Colombo, gold and silver's bull market is still in its infancy. How do you know? Because the dumb money is more interested in selling their precious metals than buying them for now. Now, one of the things where you can see this is the premium that is being offered, the premium or discount that is being offered on gold and silver eagles. And right now, gold and silver eagles, when a dealer is buying them back, they are offering less than spot instead of way over spot. And the monthly sales annualized in thousands of ounces. And so here we are annualizing. This is January data. So we're annualizing January data. But in January, with that big run-up, if you take that times 12, you end up with this pitiful amount. So gold and silver eagles are down, and the public was selling during this big run-up in gold and silver. What was it causing this? Mostly like China getting in on the game. So in my book, there is a chapter called The Point of No Return. The Point of No Return was the name of the chapter, and it ends with this one chart that wraps it all up. This is the 5-year change in gross domestic product divided by the 5-year change in gross federal debt. And so the critical threshold is $1. In other words, if you borrow $1, how much GDP growth do you get in 5 years? And the growth after World War II, you would borrow $1, go $1 deeper in debt, and GDP would grow by up to $8, but somewhere between $6 and $8 of growth. And then this fall, as we abandon gold in 1971, that's where this the direction of this really changes, because the gross federal debt could explode. Gold wasn't keeping it under control like it used to. I mean, they were cheating gold with, the classical gold standard couldn't cheat gold before World War I. But then with the Federal Reserve Act of 1913, and the Fed opened its doors in November of 1914, by the way. That's when they started manipulating the economy, and there was only a 40% reserve ratio. So they're trying to cheat gold, and gold was the big balancer, the thing that kept everything humming along in balance in the global economy. And so they're cheating gold now. But then the Bretton Woods system, and then Nixon takes us, that kept us sort of in line. And then Nixon takes us off of gold in 71, and that's when all of the deficits could just explode. Now, something happened in 2008, and I call it the introduction of Bernankenomics. We create currency, the whole economy is different than it was before Ben Bernanke. We do everything, the way currency is created, the way the Federal Reserve manipulates markets. What has happened since then is for every dollar we borrow, we get about 50 cents of GDP growth, and that is continuing. And so they're going to spend $2 trillion this year in deficit spending. We're borrowing that much extra, going that much deeper in debt, but we're only going to get $1 trillion worth of GDP growth out of it. So we're going to be another $1 trillion deeper in debt because of this. It just doesn't stop. So gold and silver are the safe haven. It's where you run to protect yourselves, and anybody in the industry should feel like they are helping to protect other people. Now, I do believe that bullion comes first. That is the major core. More than 50% of my I never give advice. I tell people what I do. More than 50% of my entire net worth is silver eagles. I have a bunch of other silver, and I own 300 ounces of silver for every ounce of gold that I own. And the reason for that is because I allow the gold-silver ratio to sort of tell me what to buy. During the COVID panic, I wanted to buy gold so bad, but that ratio went all the way up to 120. I couldn't buy any gold when silver was selling at such a discount. Everybody wanted to get rid of silver and buy gold for some reason. So I bought a bunch of silver and no gold during that period of time. And it has, My average buying cost on my silver is about $13 an ounce. So I've done very, very well. Gold and silver are the number one performing assets of this century, other than ones that start out at zero like Bitcoin, the first brand new financial class in hundreds and hundreds of years.
Silver's recent move into triple-digit territory, even if brief, confirms a long-standing trend driven by shifting investor behavior and underlying fundamentals. Historically, major price surges have not been the result of manipulation alone, but rather a broad change in public preference. When confidence in currency weakens, demand for tangible assets rises rapidly. The latest rally reflects similar dynamics, where silver outperforms due to its accessibility compared to gold. As capital rotates, even small inflows can create outsized price movements, especially in a tighter physical market. Despite volatility, the broader cycle appears far from complete. The recent spike serves as a preview rather than a peak, suggesting that future moves could be even more significant as the gold-to-silver ratio adjusts. This positions silver as a high-upside, high-volatility opportunity within the current macro environment. Let's get into the interview.
Gold is the safe haven investment where people run to during times of political upheaval, war. You saw what happened right after the pandemic, for instance. So anytime people have anxiety, they rush back to the precious metals. Silver is very undervalued compared to gold, but it's not over until it's over. Now, this is a picture of the Dow-Gold ratio. I like to use the Dow-Gold ratio versus the S&P 500. When I was a kid, people didn't even know what the S&P was. The news media, everybody referred to the Dow always. The Dow Jones Industrials have sort of taken a back seat for the past, during this century to the S&P 500. But the Dow, when you divide it by gold, it reads in whole numbers because the points on the Dow are a lot higher. When you divide the S&P, you get these ratios of 0.0 something, and people just don't think that way. So anyway, what you see here is this goes back to 1968. And in 1971, gold became free trading and took off and went from $35 up to just a whisker away from $200, while the Dow had bumped its head on 1,000 points and gone sideways for 16 years with one major pullback happening in 74. So when you divide these two, you're showing the balance, whether one is in a bubble or undervalued. And what you see here is that in the 70s, gold became free trading and started to take off like a rocket. And then gold is going up, and the Dow also fell by almost 50% during the 74 bull market. And then the Dow bottomed and gold peaked. Gold was at about just a whisker away from $200, and then fell all the way to 103. That's the reason this ratio rises. And then the Dow was rising, gold was falling. And then here, the Dow goes sideways. This is all just gold rising while the Dow is bumping along sideways at 1,000 points, basically. And it went to an intraday ratio of 1-to-1. There was a day in January 1980 where gold hit $873 and the Dow was at 873 points. So this is just showing the economic balance between the two. And then we went into the greatest stock market bull in history, and the Dow went from 1,000 to 10,000, while gold was in a 20-year bear market going from 850 down to 250. So that's the reason this ratio rises. Gold extremely undervalued here. Stock market extremely overvalued in the NASDAQ bubble. The bubble pops. We've gone up and down, but what's interesting, look at the cycle here. You've got this one big move down, a retracement up, and then a big move down. Here, you've got this one big move down, a retracement up, and we're beginning. I believe that we are just beginning this, and we are destined for something, under this ratio of 5. I think you may see this go to a ratio of 0.5 instead of 1. In other words, the price of gold will be double the points of the Dow one day. That's within the realm of possibilities because it's been more out of whack than at any time in history when it goes back into balance. And so for that to happen, either the Dow has to fall dramatically, gold has to rise dramatically, or both can happen simultaneously, and it doesn't have to be as dramatic a move for either one of them. The gold-silver ratio, these things have to resolve. For this bull market to be over, for it to be too late to make the big gains on gold and silver, these things have to resolve. Here we've got the price of gold divided by the price of silver, so the gold-silver ratio. And when it's up near the top, silver is way undervalued compared to gold. And I need to point out, we're at 60.41. How often has it been 60 or above in the past 2,500 years? Well, this can actually be measured. There's some years here going back to the late 80s, and then there are some years in the 30s. But it isn't even like 1% of the time that gold and silver have been money. We have been, for this entire century, we've been in this incredibly rare event and rare opportunity to purchase silver when it is so incredibly undervalued to gold. Now, it takes I discovered all this. I started tracking all of this back in the early 2000s. And I started buying gold when it was, the spot price was $315 when I first bought gold back in October 2002. And then I discovered how undervalued silver was in early 2003. And I started buying silver when it was below $4.40. It was $4.37 or something like that, the spot price. It was below $4.40. And I've been accumulating ever since. But like I said, these things aren't over until they're over. Now, the reason I drew this purple rectangle here is back in the 70s when gold became free trading, August 15th of 1971. So that's right up in here. Silver was going up and down and so on. It was already freely traded. So that's the reason for this bouncing around. When gold was actually fixed. But then gold became freely traded as well. And during the 70s, what the markets thought was sort of fair value, a fair balance between gold and silver, is that about 30 to 40 ounces of silver should be required to equal the same value as 1 ounce of gold, the same price, not value. There's a big difference, actually, and I've been teaching that for many, many years. We'll get to that in a different video. But look at where we've been since 1990. Silver, there are these rare instances where it was hitting 100. Now, it's only done that. Anything over like 90 can be measured in months over the past 2,500 years. And during the COVID crash, I was able to significantly increase my position at about 110 to 1. So when it went down to 55, I could have sold the silver that I had accumulated here and purchased twice as much gold than I paid for, basically. I do believe that you are going to see this drop below 20 one day. It is probably on its way down to like 10. I don't know. We've never been in this position before where silver, the above ground stockpiles, are so incredibly dear. They are very rare.
What's unfolding in precious metals is not just a price move. It's a long-term rebalancing between financial assets and real value. The relationship between gold, silver, and equities is shifting, signaling that traditional market dominance may be nearing a turning point. The Dow-to-gold ratio and the gold-to-silver ratio both highlight how distorted valuations have become. Silver, in particular, remains historically undervalued relative to gold, presenting a rare setup that has only appeared in extreme periods across centuries. As these ratios normalize, the adjustment could be dramatic, driven by either rising metal prices, falling equities, or a combination of both. This environment suggests that current conditions are not the end of the move, but the early stages of a larger transition. As capital begins to recognize this imbalance, the upside potential in precious metals could expand rapidly. Share your thoughts on his analysis in the comments section below. If you find this video informative, please support us by liking this video and subscribing to our channel for more financial insights. Don't forget to hit the notification bell so you never miss an update. Thanks for watching.